Anthony Grasso here, bringing you financial news that you can use. In this particular video, I'm going to do a stock analysis on GlobalFoundries. Is this semiconductor company worth investing in right now and is ready to pop? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. As always, folks, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you get up to 12 free stocks by using my referral link in the description down below. All right, so GlobalFoundries operates as a semiconductor foundry worldwide. It manufactures integrated circuits which enable various electronic devices that are pervasive. Now, the company manufactures a range of semiconductor devices, including microprocessors, mobile application processors, baseband processors, network, radio frequency modems, microcontrollers, power management units, and micro electromechanical systems, as well as offers mainstream wafer fabrication services and technologies. It was founded in 2009. It's based in Malta, New York. Now let's go ahead and look at some of the news over the past couple weeks of this company. Now on August 8, Qualcomm agreed to buy an additional 4.2 billion in semiconductor chips from GlobalFoundries. Now from the New York factory, now bringing its total commitment to $7.4 billion in purchases through 2028, according to the final release last couple weeks ago. Now, the announcement expands on the prior $3.2 billion purchasing agreement between the two companies and will produce chips for use in the 5G transceivers, Wi-Fi, automotive, and the Internet of Things connectivity. Now, the U.S. chip maker Qualcomm, which specializes in mobile phone chips, was one of GlobalFoundries' first customers to sign a long-term agreement back in 2021, covering multiple geographies and technologies, according to the press release published by the firms. Now, GlobalFoundries chief executive Thomas Caulfield said in a statement that having Qualcomm as a long-term customer of its upstate New York factory would help, along with federal and state funding, to expand the company's U.S. manufacturing footprint. And with the CHIPS Act packs, they did. And it's very important for me to look at semiconductors to have long-term contracts is definitely a huge plus for this company. So let's look at some of the fundamentals right now of this company. Well, the stock is currently trading at $60.46 a share, with a market capitalization of roughly around $32.7 billion. Now, the company is projected to have about $8.06 billion of revenue in 2022, with earnings estimated to be about $1.27 billion. Now, the revenues are projected to increase over the next few years to around $9 billion by the end of 2024. Now, the earnings are projected to increase into 2023 to around $3.11 billion and then decrease in 2024 to around $1.72 billion. Now, that's probably because they're investing more into research and development and new plants and everything like that. So the revenue forecast is to grow about 5.9% per year. Now let's look at some of the key fundamentals of the company right now with the key measures and valuation analysis. Because GlobalFoundries has positive earnings, we're going to use the price to earnings ratio for relative valuation analysis. Now, the company seems expensive based on its price to earnings ratio of 64.9 times compared to the US semiconductor industry average of 19.3 times and its peer average of 32.2 times. Now, if you look at the price to earnings ratio versus the fair ratio, we compare that to taking into account the forecasted earnings growth, profit margins, and other risk factors. It does also seem expensive based on the price earnings ratio compared to the estimated fair price to earnings ratio of 34 times. But if you look at the share price versus the fair value when looking at its future cash flows, for this estimate, we use a discounted cash flow model. It's trading below the estimate of fair value that we put around $134 a share. Now, looking at the profitability of this company, well, the profit margin right now is at 6.6% at the end of June. It does have a growing profit margin and has become profitable over the past year or two. It doesn't pay any dividends like some of its peers. And looking at the growth analysis, CNBC doesn't have the information right here, but you can see the average industry sector average in S&P 500 for my comparison. So the earnings trend has become profitable over the past 5 years, and the earnings have grown 73.3% per year. It does have a high quality earnings. And finally, let's just go ahead and look at the financial strength of this company. The company's debt to total capital ratio is approximately 25%. Now, the short-term assets of 5.5 billion do exceed both its short-term liabilities of 3.3 billion and its long-term liabilities of 4.2 billion. Now, its debt level is good. It has more cash than total debt, and its debt is well covered by operating cash flow of 171%. And the interest coverage, the company's interest payments on its debts are well covered by EBIT of 7.8 times. So what did the analysts specifically say regarding this company in general? Well, the analyst consensus is a buy to strong buy, with 53% saying buy and 33% saying strong buy. The average price target of these analysts are $70 a share, $70.15 a share over the 12 months, with a high of being $100 a share and a low of being $31.20 a share. Now, going over an analyst report that I found the Forward Equity Research Report. Now, they project that this company will perform in line with the market over the next 6 to 12 months. This projection is based on their analysis of 3 basic characteristics that influence the common stock performance: earnings strength, relative valuation, and recent stock price movement. So am I buy, hold, or sell recommendation on this company? Well, here are my thoughts. Now, the semiconductor manufacturing company is making significant progress over the past couple years. The company has not changed the longer-term earnings model they're currently under, which I believe is a good outcome. They offered several good points highlighting the company's longer-term objectives recently. They have built long-term partnerships with companies like Qualcomm and Qorvo. Now, these relationships have even more potential to further diversify revenue in the years ahead. The long-term agreements demonstrate both customer focus on improving the uncertain supply chain, but also customer desire to continue to build on what has become more of a partnership culture rather than just a transactional relationship between these partners. Now, the company is also well positioned should geopolitical tensions ratchet up overseas, as GlobalFoundries is only a pure U.S. foundry. Now, the U.S. Senate last month passed a sweeping legislative to subsidize the domestic semiconductor industry, providing about $52 billion in government subsidies for semiconductor production and an investment credit, tax credit for chip plants estimated to be worth $24 billion. With major new federal incentives for microchip manufacturing in the United States, I think this will ensure positive future results for GlobalFoundries. Now, thanks to the passage of the CHIPS Act, they will be able to forge ahead with its planned semiconductor factory in Saratoga, New York. While the company was likely to proceed with the new plan anyway, management had previously said that the plant would have to been delayed without the CHIPS Act subsidies. Now, that's because it would have had to wait longer and build up cash in order to fund the new plant. A faster time to construction and subsidies will speed up the time to get the plant up and running, and therefore generate the revenues and cash flows sooner than later. That would most likely will boost GlobalFoundries' intrinsic value due to the time value of money. Also, GlobalFoundries is also a potential hedge against any war in Taiwan with China. So based on all of that, I'm a buy recommendation on GlobalFoundries, and I put a 12-month price target of $72 a share. Now, there are risks to my recommendation, and that's a big risk if chip demand falls over the next year, which would outweigh solid earnings. You know, recent cautionary comments from both NVIDIA and Microtechnology a couple weeks back, it spurred a broader sell-off in the semiconductor sector over the past couple weeks previously. Now, GlobalFoundries belongs on investors' radar right now for exposure to the lagging edge chip boom and that potential hedge against a war in Taiwan like I talked about. But what are your thoughts? Please leave your comments down below. So there you have it, folks. As always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell to like your daily stock reviews and cryptocurrency reviews on a daily basis. Until the next stock update video later today, folks. Ciao.